All right. Hi. Good morning, good afternoon, good evening, wherever you are around the world. I am so pumped up doing this. It's been a long time coming. I've been getting lots of requests. Look, can you teach the basics? Give us content on the basics of investing in the stock market. Start from the simple things. And I totally get it because, yeah, you might say a lot of the content I do is a bit can be a bit complex if you're just new to financial markets or new to the stock market or even just new to investing. Because remember, a lot of these things aren't taught from the elementary level for a lot of people who go to the formal educational system. They're not taught. And even in the informal education system, it isn't taught. So this is Stock Investing for Beginners Part 1. Now, initially, my plan was to do a 1 hour video, but I thought, look, 1 hour is a lot. Attention spans are drastically reduced these days. So this should maybe be maybe at tops maybe a 20 to 30 minute video. If it's less than 15 minutes, it's going to go on LinkedIn. If it's more than 15 minutes, LinkedIn doesn't give me the chance to do so. For my peeps in TikTok, this will go in TikTok in bits and pieces. So YouTube, you get the whole enchilada, you get everything all at once because YouTube gives me the chance to do so. Every other place, I'm going to chop it up into bits and pieces. So if you by chance are coming from TikTok or anywhere else, you can access my YouTube. You have the YouTube link, then you get everything here. So let's get right into it. What are stocks? Stocks are parts of a business, they're a piece of a business. So if you have a company that is listed on a stock exchange, it is known as a public or listed company. You also have stocks in a private company. Now, if you own stocks in a company, that makes you a shareholder or a stockholder. I think stockholder nowadays is a bit of an antiquated term. So shareholder, I guess, is the more mainstream and a more common term used. So, what's the difference between stocks and shares? Now, nowadays, the terms are used interchangeably. But if you want to be a bit technical, shares refer to stock in a particular company. And while the term stock means you are referring to shares generally. So, the same way you have, how do I put it? You have real estate, for instance. When you say, I'm invested in real estate, that's a general term. If you want to then drill down, you can now say, oh, what kind of real estate? So it could be residential real estate, it could be commercial real estate, it could be mixed real estate. So you can kind of apply the same, will I say, the same logic to the whole stocks versus shares thing. But essentially, we use both terms interchangeably these days, but that's just the technical difference. So why do people buy stocks? You buy stocks for two reasons, or maybe three, but at least the two financial reasons for dividends and then for capital appreciation. The third reason is not necessarily financial, but you might assume it happens. For some people, you might say it's a form of some form of vanity investing, right? So some people might hold shares in the company, not necessarily because of, say, dividends or capital appreciation. It could be for emotional reasons. It could be, oh, my family is involved in this, so I'm just going to hold it. I don't really care about the fundamentals. I don't care about the dividends or capital appreciation. It's nice to have, but if it doesn't come, I don't care about it. That's for some people. But the two reasons why people invest in the stock market for dividends and capital appreciation. Now, it doesn't have to be an either or situation. You can combine both. Some stocks may pay you a dividend but may not grow very healthily in terms of value over time. Some stocks may, at a point in time, have massive capital growth or capital appreciation, but may not pay a dividend. And at some point in the series, I probably will do types of stocks and all that. So I think I'll probably do that at a later series. But these are the two broad reasons. And you can combine both. You have stocks that combine both as well. But let's start with dividends. Dividends are portions of profit paid by a firm to its shareholders. Now, some companies may pay dividends annually, that is once a year. Some companies may pay dividends quarterly. That is at the end of every quarter. Essentially, a quarter is 3 months, and that's pretty common in global markets. For my Nigerian audience, you don't have too many companies that pay dividends quarterly. I think the first that comes to my mind is Seplat. Seplat is an oil and gas firm. Seplat pays a dividend every quarter. Then you have a couple of firms in the financial services space, the banks, I think one insurance company. The banks tend to pay a interim dividend mid-year after 6 months at the end of the first half, and then they pay a final dividend. So you have your likes of your Zenith, your GTCO, your UBA. On the insurance end of things, you have what I think custodian investment pays an interim dividend and then the final dividend. Agri space, they also tend to pay several dividends. So the likes of Okomo and Presco, I will pay you a dividend at half year and then the final dividend. Final meaning at the end of 12 months, they will then pay you a dividend. What is capital appreciation? Capital appreciation is an increase in the value of an investment, in this case stocks. Now, simply means that the investment is at that point in time valued higher than the price at which you bought it. Now, share prices are not static. Share prices go up and they go down. They go up, they go down, and that's on a daily basis. Now, some days they are flat, but typically you would have share prices move up and down every day. Sometimes big movements, sometimes small movements, sometimes flat. So capital appreciation is not static. So if you bought a stock, I mean, for instance, let's use GTCO. If you bought GTCO at, say, public offer last year was, I think, 44 naira and 50 kobo. GTCO moved from 44 naira to what? It's around 90 something naira. So that's an almost 100% capital appreciation. Somebody else may have bought GTCO at 80 naira or 90 naira or even 100 naira. So for the person who's bought GTCO at 100 naira, GTCO is trading at around 90 something naira today. That is a decline in its opposite side of capital appreciation. You might say, will I say capital depreciation? No, you might say that's a loss, right? In capital terms. But for the person who's bought at 44 and bought at 80, then they probably are in profit. But the magnitude of profit will differ from person to person. So capital appreciation is not a static concept because stock prices move up and down. So it's possible if you buy a stock at, say, 40 naira or 50 naira, the stock can go up to 70 naira, it can go down to 30 naira, it can go down to 20 naira. So that's what capital appreciation means. So how should one approach stocks? I think people always forget that stocks are a high risk investment. Now, does that make them a bad investment? Not at all. It simply means that if an investment is high risk, you should not have all your funds invested in such an asset. You should also not have funds for your daily needs in the stock market. So your feeding, your rent, your school fees, your upkeep, money that you're going to need in a year or less, or 6 months or less, that money should not be in the stock market. Stocks also are ideally an investment you do with patient money or a patient outlook. You might say patient capital. Why do I say so? When you invest in a stock, you're buying a piece of a business. And remember that businesses do not often make money literally overnight. It takes time for businesses to sell a product, get the money, and then report to the investing public via the financial statements. So you need to have a mid to long term perspective when it comes to stocks. So what's your definition of mid to long term? I mean, mid-term, you might say what? Maybe 12 months, 18 months, 24 months. Some might put that as short term. I mean, if you want to if you want to be, I would say, exact, you might say short term could be, short term could be 3 days, 4 days, but that's in a trading perspective. If you're an investor, then typically your short term could be maybe 12 to 18 months. Your midterm, maybe 18 to 24 months. Your long term, a couple of years. It could be 5 years. It could be 10 years. In the next video, which will be more practical, I'll show you a couple of charts. One of them, but you can also Google the charts as well. I mean, if you take Netflix, by all standards today, it's a successful company. But if you look at the Netflix charts, it was flat. It was essentially barely any price movement for a decade. It took a decade, and then COVID happened, and Netflix picked up and ran, and it's been running since then. So if you're an investor, if you're not a trader, you need to have a mid to long term perspective. So you need to say, look, I'm holding this stock at bare minimum midterm. I want to hold it for 18 to 24 months. In some cases, you want to hold it longer. A common question I often get is, when should you exit the stock? It all depends on you and all that. So this is the approach you should have with stocks. Stocks are a high risk investment. I know there's a lot of excitement about stocks. Should I buy? Should I sell? Oh, stocks are buzzing. I mean, the NGX, Nigerian stock market, is up by over 30 something percent. You've had several stocks doing 50, 60, 70, 100% returns just within the year 2025. So, and even on in the global scene, I mean, Palantir is probably one of the biggest examples of stocks that have had a run the last couple of years. Nvidia, I think last year was one of the best performing stocks. So, I mean, it's all well and good. It's nice to hear such tales, but remember that stocks are a high risk investment. And till you cash out those gains, at best what you have are paper profits. So that's why you often hear some people tell you, take some profit off the table, meaning if stock has run massively, you've made huge capital gains, sell off a bit and move it to a high risk investment. I mean, when to do so, it all depends on the quantum you have, your strategy, how investment savvy you are. But that we can deal with at a later episode. So this is how one should approach stocks. Now, just because I said stocks are a high risk investment, I thought to segue a bit into the broad classification of investments, because you might then ask, oh, if stocks are a high risk investment, you should not have all your money in stocks. Where else should one have money in? And as always, I probably should have included this disclaimer somewhere in my slides, but probably it's not too late to mention it. Nothing I say is investment or trading advice. These are my thoughts. At best, you might say maybe this is literary stuff or financial literacy or educational content, but it's not investment advice in any way, shape, or form. But a segue into just the broad classification of investments. You have low risk investments, medium risk investments, high risk investments, and very high risk investments. Now, an ideal portfolio should have a blend of low risk, medium risk, high risk, and very high risk. What that blend is, the composition of that blend is a function of a couple of factors. It's a function of your age, your risk appetite, your income, and your investment goals. So a portfolio is a collection of different assets owned by a person. It could be a person, it could be an institution, it could be both. So your ideal portfolio should have a mix of everything, and that mix changes with time, because obviously how you invest or your portfolio composition in your 20s, it's different from your portfolio composition in your 50s. Your portfolio composition, I would say, when maybe you're investing $5 a month, $10 a month, 20,000 a month, would probably be different from when you are able to, say, invest, say, millions of naira a month, or thousands of dollars a month, or tens of thousands of dollars a month. So it's a fluid thing. It's not static. Your investment portfolio constantly changes shape or form. So what are low risk investments? Examples of low risk investments are cash or near cash investments. You have fixed deposits, you have sovereign treasuries. Sovereign treasuries is debt issued by countries. I must also say that even in terms when you discuss risk, an investment class or asset class can be low risk, but within that class, you could have different categorizations of risk. So, for instance, you have treasuries, right? Treasuries are debt issued by countries. A Nigerian treasury bill has a higher debt rating compared to, say, the UK or compared to the US. So treasury bills broadly are low risk investments, but obviously the risk rating would vary from country to country. So it's a debate people even have when we say stocks are a high risk investment. Obviously, yes, but even within that, some stocks are riskier than others. So um, if you take a biotech stock, for instance, maybe the company is a biotech stock or a pharma stock that is working on a possible cure for a rare type of cancer. That is way higher risk as a stock compared to, say, maybe a Coca-Cola. Because when you say Coca-Cola, I mean, what is the biggest risk with Coca-Cola? People stop drinking Coca-Cola. But obviously, that wouldn't happen overnight. In some cases, probably might never happen. You would need a serious health or medical concern flag about Coca-Cola to make people stop drinking Coca-Cola. So obviously, if you take a Coca-Cola or if you take a biotech firm, if the risk classification is different. So they are both risky investments. They both high risk. Some are obviously riskier than others, especially in the short to medium term. I just thought to explain that. So low risk investments, you have cash, you have fixed deposits, you have sovereign treasuries, and the role is to provide stability and protect your capital. So a lot of times, low risk investments aren't going to make you money. That's not the goal of low risk investments. The goal is to keep your capital safe, to provide stability and all that. Now, to medium risk investments, you have real estate, you have corporate debt, and obviously, like I said in the previous slide, risk differs from one country or one type. So if you say real estate, it's typically medium risk. But if you take real estate in a setting where land use laws are ambiguous, titling is ambiguous, it's different from a place where those things are much more organized. And if you can read between the lines of what I'm saying, then you get it. And if you can't, well, you have to listen to the video again. So I'm aim for medium risk investments is to provide growth potential while still maintaining a buffer of safety. So medium risk investments, I say I'd step higher, or a range or a step higher from low risk investments. Why? Then there's a level of stability that medium risk investments have. So with real estate, I often like to say, when I'm talking with clients on a one-on-one basis, that look, a house, the value of a house rarely goes to zero, or the value of a piece of land will rarely go to zero overnight. You will need an extreme policy for that to happen. Now, for corporate debt, obviously, again, the same disclaimer applies. There are levels of corporate debt in terms of risk. So a corporate debt, a bond, say, issued by Coca-Cola, and a bond issued by a 2-year-old startup. I don't even think 2-year-old startups can issue bonds. But let's say bond issued by a startup. The bond issued by a startup is riskier. Startups are way riskier. A bond issued by Coca-Cola, I mean, in some cases, I wouldn't be surprised the bond issued by Coca-Cola in terms of risk probably would have, just slightly higher risk rating above that of the government, because Coca-Cola is over 100 years old, I think. It's not going anywhere anytime soon. So even if it's a 4-5 year bond, Coca-Cola ain't disappearing in 4-5 years. I don't know about the next 30 to 40 years, but so you get the gist, right? But the role is to to provide you a bit of growth potential, and to provide you slightly better returns than I would say low risk investments in the case for corporate debt, while still maintaining a decent safety buffer. Now, for high risk, you have stocks, you have commodities, examples of commodities. I mean, you can break commodities into a whole segment, and I think if you're on Spotify, I did an episode on commodities. You can search the Spotify podcast for commodities. At some point, once I've done the beginner episode for stocks, then I'll start talking about commodities as well. Because this channel isn't just about stocks. Yeah, a lot of it's about stocks, but I'll talk about other things as well. So, I mean, you have stocks, you have commodities, and the goal for high risk investments is to provide you potentially higher return. Now, it's potential. It may or it may not happen. especially in form of capital appreciation. But obviously, the higher the risk or the higher the potential risk, the higher the return you're aiming for, then the higher the risk involved. So high risk investments tend to be extremely volatile in price movement. And that's why I say stocks are high risk investments. Stocks prices are volatile, they're not fixed. They go up and down on a daily. You also have a much higher, quicker probability of losing money. Yes, it is true that for blue chip stocks, they're not going to zero overnight, but sometimes things happen, and you can see, if a company, essentially, the value of a company goes to zero, if the company goes into a bad place, and essentially you have to write everything down, that is money you're going to lose. So if you take real estate, for instance, you still have property, right? Now the value of the property can change, but you still have a base level, a crisis level value of property that you can use to estimate. You can't do the same with stocks. I mean, if a company folds up, a company becomes bankrupt, I think that's a proper term. Then that's the value of the shares. Essentially, shareholders, in terms of precedence, actually, people who have lent a company money take precedence over investors. So if after they've settled creditors, there's nothing left, that means essentially you're holding your investments have become worthless. So it's important to note that when it comes to high risk investment. And then you have very high risk investment, cryptocurrency, startup investing, buying vintage stuff. Now, to the goal for high risk investment, or also very high risk investments, to provide you potentially higher return, especially capital appreciation. But like stocks as well, or like the high risk investments, they tend to be extremely volatile in price movement. I mean, if you look at the price of Bitcoin, Bitcoin is a cryptocurrency. Bitcoin prices can be, I mean, yes, you might argue that, look, as Bitcoin becomes, or cryptocurrencies become a more mainstream asset, that volatility is reducing, but it's still quite volatile. In fact, I would say they're probably even technically more volatile, because with your stock market, if things become heated in the stock, trading can be paused. If things become heated on an exchange, trading can be paused for the exchange as a whole. With crypto, there's no pausing. If things become heated, I mean, well, you might have one or two crypto exchanges buckle under the pressure, but trading is 247, 365 days a year. That in itself comes with its own risk. So, as I said, you want to have a mix of all those assets. So now back to the lane of stocks. How do you analyze stocks? You can either pick the the top-down approach, or bottom-up approach. Now, you can find an article on this on the Green Ticker Tales website. You can also find a podcast episode on this as well. So just in case I don't go too heavy into the details, you can also refer to this as well. I'm pushing 23 minutes here. I didn't know I was going to take that long. So hopefully I should be able to upload this video. Hopefully. So how do you analyze a stock? You can pick from the top-down approach, or the bottom-up approach. So if you say top-down approach, you start from the economy, the broad, big picture as a whole. You look at an economy. What are the different sectors? What sectors have growth potential? What sectors are dominant or struggling? And then you drill down to the players in those sectors. You can also flip it. So you can say what sectors are doing badly and why. Are they one-off issues, or are they structural? So let me give an example with Nigeria, a simple example, or any emerging market country, because my audience isn't just Nigerian. I'll use two examples. If you take the US, for example, investors will tell you the US is an economy that's very consumption driven. So you look at what are the areas of consumption, what are the areas that have a high level of consumption. It's a very consumption driven economy. A huge chunk of the GDP, gross domestic product, generated in the US, is around consumption. And so you can then look at, say, for instance, I want to look at housing. Housing is a major part of US GDP. What are the sectors in housing? What's doing well and why? What's doing badly and why? And I can then look at the listed players and then see how they fit. So that is an example with a mature market. I can take a emerging market, or a frontier market, where Nigeria is, because Nigeria is more frontier than emerging. Emerging will be your China, and then a step lower than that are frontier markets. I can say, look, Let's take a frontier market like Nigeria. What are the dominant sectors? You might say agriculture. And you look at agriculture, what are the players in the agriculture? What kind of agriculture? Are there listed players in agriculture? What are they doing? Are they doing well or not? I can also flip and say, look, what sectors are doing badly? Um, this is where your knowledge of economics, macroeconomics, and macroeconomic factors come into play. Because if you understand the macros, the macro shape or the macro conditions of an economy at some point in time, you can then know how to position, why to position, and when to position. So if you take Nigeria a few years ago, I think 2 years ago, we had a double whammy. We had a big devaluation of the exchange rate that led to a spike in inflation that had some positive effect for some sectors, had some negative effect for some sectors. That cycle is a cycle that repeats itself every 7, 4, I mean, you could say on average every 4 to 7 years, you're having an economic shock. You also have broadly, globally, the same cycle as well. So I can even say a top-down global approach. I take the world and divide it into sectors. What countries I want to play in around the world? What sectors of an economy do I want to play in globally? Everybody is talking about AI and tech, but there's healthcare, there's defense. What are these companies in these sectors operating globally? And then I drill down. So you can take either a top-down approach, like what I've explained, or you can take a bottom-up approach. I pick a sector, I pick companies. What companies are doing well and why? What are the companies with growth potential or dominance? Why are they working and why? I can also flip it and say what sectors in an economy are doing poorly. Is it a one-time thing? Is it something I think is going to be sticky? If it's a one-time thing, I can say, look, this is a one-time event. Let me look for companies I think are the strongest fit here. So which should you approach is better? Both are useful. In my own investing, I use both top down and bottom up. Now, if you're looking at bigger countries, I mean, if you're taking the US, for instance, the US it's one of the biggest economies in the world. So you you'll probably be better off looking at, because you have bigger economy, bigger companies, global impact, global operations. You want to maybe take a top to bottom approach. But if, for instance, you're based in the US, you're a domestic US investor, you might say, look, let me start from the bottom up. So both approaches work fine. In fact, actually, if you're a decent investor, you should be able to combine both, because nowadays, as an investor, you're playing across countries, you're playing across continents, you're playing across different places as well. So it's best to combine both. Now, how do you analyze a stock? You have technical analysis and then you have fundamental analysis. What is technical analysis? Technical analysis is concerned with price movement. It could be historical price movement, movement of price in the past, or it could be price movement currently at this point in time. I must also state that you can apply both fundamental analysis or technical analysis to other sectors. So it doesn't just have to be about stocks. You can apply fundamentals to the crypto space. You can apply technicals. In fact, technicals have probably a broader application of things, because you can apply technicals to anything that has price history, right? You can apply technical analysis to to the um, to the currency market, for instance. You can apply technical analysis to the crypto space. I mean, wherever you these are skills that once you get the hang of it, you can apply anywhere. So technical analysis is concerned with price movement. It could be historical movement or it could be current price. Now, fundamental analysis is more concerned with figuring out the intrinsic value of a stock. What do I think this stock is worth? Is it underpriced or overpriced with respect to its current price? So that's something that you'd have to figure out in terms of if it's working or not, right? Now, common technical analysis tools, you have trend lines, you have moving averages, you have trading volumes, and I do a whole series on technical analysis once I'm done with fundamental analysis, which is the bulk of it to be examining financial statements. So at some point in time, probably in a couple of weeks, what I've decided to do is that every Saturday I would have a beginner series episode. So I'll create a playlist for this and do every Saturday, um, depending on the earnings season. I mean, right now we're kind of approaching the end of earnings season. That gives me time to do beginner content. Now, if and that where we're in August, so um by October, early October, you'd have lots of results again. So I might say, you know what, let's use no, January, February, March, that's first quarter, April, May, June, second quarter, July, August, September. So I'm right. So by July, August, September, that's third quarter. So by October, you'd start to have numbers coming in and all that. So I would say we could use the remaining couple of weeks to do a beginner series, stocks, crypto, commodities, and then by October, it's back to regular programming. So not to worry, I would have a video, detailed videos on all this as well across the channel and all that. So common technical analysis tools, trend lines, moving averages, trading volumes, and I would explain. I mean, if you go online, you can easily see one of the most common, I would say, tools or essential tools in technical analysis, just basic support and resistance. Again, I would refer you if you are following on the Spotify podcast, and you should be because you probably will have more content go out in quicker real time on podcasts compared to videos, because podcasts I can do 4 5 episodes, 5 10 7 12 minutes in a day. I can't do that with YouTube. Volumes will start to lag and all that. So that's for technical analysis. Now for fundamental analysis, you have qualitative and quantitative components of fundamental analysis. And when we say qualitative, your biggest factor to look at is the quality of management. How do you determine quality of management? I think one of the ways to do so, it's an easy way, is to say, look, what's the competition saying about them? A competition cannot always be biased. You might have competition that's biased, but the honest truth is, you might ask yourself, what are people saying about them? What's the kind of experience a management has? Educational backgrounds, working experience, and all that. That's one of the factors you look at when you're looking at management of a firm. Now, for quantitative factors in fundamental analysis, these are more numerical factors. Your revenue, your margins. Your margins could be profit margins across, whether it's net profit, profit after all expenses deducted, gross profit, which is profit after you deduct cost of sales. You have your operating profit margins, and you'd see all these examples once I get into the thick of it. You have the CAGR, cumulative average growth rate. If you follow my videos I've been doing on results and companies, CAGR is a number or a term. It's a term actually that has been pretty recurrent. So these are the factors I look at. Now, FA, which is fundamental analysis, versus TA, which is technical analysis, which is better. Both are useful. Now, you can think of fundamental analysis as a base. If you are a trader, you don't necessarily need fundamental analysis, because your trader are looking at price movement, current price movement, historic price movement. But even as a trader, you want to be careful, because if you are trading an asset that has poor fundamentals, in this case, we're referring to stocks. You're trading it in stocks that has that poor fundamentals, or it's really badly run company. You could wake up one day and say, "Hey, this company is suspended from trading, or this company just goes down the drain overnight." So you can't divorce both fundamentals and technicals. I mean, obviously, for an average person, fundamentals are easier, but honestly, I think technicals are pretty simple, because nowadays you have technology. Once you know the terms, once you know what, I mean, something as simple as support and resistance, it's not rocket science to understand support and resistance for a stock. So I mean, I think technical analysis is an add-on. If you don't know it, or if you just don't want to be bothered, which I mean, I think you should, but if you rather not, fundamental analysis then comes into play, because once you figured out what do I think is the value of this firm, why is this stock trading and where it is, um, you can now, I mean, fundamentals always fundamentals are essentials. They're almost, you can't run away from them. A stock will always at some point in time trade at its fundamental value. Now that fundamental value will change as the company becomes bigger or smaller, as it goes up and down in the business cycle and all that. But so both are complementary when it comes to investing in the stock market. So I see you same time next week, and next week I'm going to go into financial statements. This video has probably run pushing 35 minutes. So um don't forget to like, share, subscribe. And I mean, that would also be the determinant of the length of the next video next week, because the aim for me was I was going to go into financial statements, and I saw that these slides were becoming too many, and this video have been long. So I don't know if people are going to listen to beginner stuff for now. I mean, if I see that the metrics, the listening metrics, engagement is great, sure, I'll maintain the length. If I see the metrics are poor, it means I need to cut down the length. And the longer it takes, the more series you have to watch. So, I mean, this video is it's all about experimenting and all that. So, I see you guys. On Spotify. Spotify content on this topic should go out 3-ish, 4-ish Nigerian time. Some of the content is already up on Spotify. I've done top down. I have an episode on top down versus bottom up investing. I have an episode on technical analysis versus fundamental analysis. So you want to check out Spotify, and as I say, try to follow all platforms. I know people have their favorite platforms, but you want to follow all, because honestly, some platforms will get more content than others. So thank you for watching so far. Don't forget to like, share, subscribe, drop your comments in the comment section. Just by running through these slides, I've kind of seen a few things I'm going to tweak, and I'm going to amend the slides and tweak them for TikTok. So from Monday, I'll be doing chopping this into bits and pieces that will go up on my TikTok channel. Link also you can find them in the profile page on YouTube as well. Thank you all. Have a great weekend ahead.